As I mentioned in an earlier video, cost flow assumptions are one of my least favorite topics in all financial accounting. But on the opposite side of the spectrum, I'm excited to share that inventory errors, it's definitely one of my favorite topics. If there is a side of you that enjoys the puzzle solving nature of accounting and likes to clearly organize and articulate a logical sequence, then you might enjoy this topic as well. It's also particularly valuable for your accounting education because error detection and correction doesn't just apply to inventory. It's part of a more generalizable skill set that is a really important accounting muscle for you to develop. Additionally, it's going to help you exercise your mastery of financial statement articulation, or in other words, having a better understanding of how, in this case, the balance sheet and the income statement are interrelated. It just so happens that in the context of inventory, we've got some really interesting outcomes to explore. But before diving in, I want to revisit the inventory equation one more time. Let's recall that the inventory equation consists of beginning inventory plus net purchases, and collectively, we refer to those two as our goods available for sale. And for a brief moment, let's take the perspective of a company that uses a periodic inventory system. The way things would naturally play out for such a company is that at the end of the period, a physical count of inventory would be taken to determine the ending inventory balance. And the difference between goods available for sale and ending inventory would be our cost of goods sold. Under a periodic inventory system, we're not keeping track of this with each individual sale. We infer what it must have been for the period by taking the difference between these two sets of numbers. And assuming that we've done everything accurately, this reported cost of goods sold would be the true actual amount. But now I want to visualize under a few scenarios what happens when we have errors for different accounts and in different directions. Let's first consider the situation where goods available for sale are overstated. This could happen for a variety of reasons, like failing to record purchase returns or accidentally recording duplicate purchase invoices. This could have been a lot of different things. But for now, we simply assume that someone somewhere made a mistake which contributed to a net overstatement in our goods available for sale. Following the logic with our periodic inventory system, we would take the difference between the left column and our ending inventory to report cost of goods sold equal to that difference. But you can see that this was larger than it should have been. So if the true accurate number for cost of goods sold should have only been the difference up until that top green line in our net purchases, we can thus quantify the size of the overstatement in cost of goods sold by the red bar in that right column. I also like to pair this visual explanation with an intuitive one. Here, you incorrectly thought that you had more product that you could sell, and so when compared to what was left, you incorrectly thought that you sold more than you actually did. A similar pattern emits in scenario 2, where now goods available for sale are understated. This time, I'll represent that understatement as a red bar that's kind of eating into our net purchases, decreasing the total height of that bar, let's say. As a result, our cost of goods sold that's reported on the income statement is going to be less than the true cost of goods sold. Thus, to the extent that we understate goods available for sale, we'll be understating cost of goods sold. One takeaway that you should be recognizing at this point is that errors in goods available for sale are directly related to errors in cost of goods sold for the same period. In our last and third scenario, we're now going to examine an error in ending inventory. Specifically, we're considering what happens when it is overstated. Maybe during the physical count of inventory, some goods were accidentally double counted, or someone made a typo when recording the number in the system. This time, I'm going to insert that red bar on the right-hand side, and thus the cost of goods sold reported would equal the difference between the total heights of the bars on the left and right-hand side. But we know that's not the right number because that red bar represents an error. That's not real inventory. The true cost of goods sold would have been larger. And so here, I hope you recognize that errors in ending inventory have an inverse relation with the misstatement in cost of goods sold. But we're not done yet, and this is what makes errors in ending inventory so interesting. If an error in ending inventory goes undetected and uncorrected, then this is actually going to impact multiple periods. Because now, the overstatement of inventory in year 1 will result in overstatement of beginning inventory in year 2, thus overstating our goods available for sale. And if you recall the pattern, you'll know that this will produce an overstatement in our cost of goods sold. Things are going to get even more interesting as we now summarize the pattern of misstatement across the 2 years. Let's start by considering the same scenario where we overstate ending inventory. If our goods available for sale were accurately measured during year 1, then an overstatement of ending inventory will produce an understatement of cost of goods sold. The intuitive explanation again. You looked at your erroneously higher ending inventory number and you inferred that you sold less than you actually did. And when this account is closed at the end of the period, you will overstate net income and you will overstate ending retained earnings. And then we move on to year 2, where since you overstated ending inventory in year 1, your goods available for sale in year 2 are now overstated, which is directly related to the error in cost of goods sold. You thought you had more available to sell, so when compared to an accurately counted inventory at the end of year 2, you thought you sold more than you actually did during the period. And with that expense account too high, you have now understated net income for the period. But now here's the best part. Drum roll, please. At the end of year 2, your retained earnings account is now correctly stated. And many students find that outcome surprising the first time. Yes, errors in ending inventory impact multiple periods, but in the end, it becomes a self-correcting error. We understated and overstated our expenses across the 2 years, but once they are both close to retained earnings, the account is now at its proper amount. And that has implications for how we try to make corrections to inventory errors. It totally depends on the timing of their discovery. For the sake of completeness, let's run through this one more time, but now using the assumption that ending inventory in year 1 was understated. And as you're probably anticipating, it's going to be the opposite pattern of what we've seen so far. Cost of goods sold in year 1 will be overstated as a result, and with that expense being too high, net income and retained earnings will be understated. The error carries through to year 2, where now goods available for sale is understated, as is cost of goods sold. And even though net income is overstated for the period, the ending balance for retained earnings will have self-corrected at this point. Typically, students need a fair bit of additional practice to nail this down, and we'll have plenty of time to do that soon. I want to conclude with a brief discussion of inventory ratios. This is largely going to track what we did with receivables in the last unit, and we'll start with inventory turnover, defined as cost of goods sold divided by average inventory. And like the AR turnover ratio, we're measuring the number of times something happened. In this case, the total number of times the company sold its average inventory balance during the period. And like before, I present this ratio primarily as an intermediate step to get to a typically more useful metric, days inventory outstanding, where we divide 365 by that inventory turnover ratio, which then tells us the average number of days it takes to sell our typical inventory balance. They give us a sense of how quickly a company sells its inventory. Lastly, I want to connect this to a concept we talked about earlier in the semester, which is the length of a company's operating cycle. We mentioned this in the context of whether an asset can be classified as current, where the time frame could be longer than 1 year for companies with unusually long operating cycles. It's defined as the amount of time it takes for a company to collect cash from the sale of inventory, and we can now objectively measure this using ratios we've covered thus far. Specifically, if we go back to days sales outstanding, which we got in connection with our AR turnover ratio, and add it to our days inventory outstanding, this now gives us, in days, the length of a company's operating cycle. And if you can believe it, we'll still keep adding to this later on in the semester.